So friends, now we have seen the first model, which is the zero growth model, in which we have seen the formula price of a share is D by KE. D is dividend of current year, or you can call it D0. Right, we have seen the example where first year dividend is 10 rupees, and then next year it keeps on, being the same amount 10, 10, 10, 10, and then we did an infinite sum of, and then we did the sum of an infinite GP, and then computed the, price of the share as 10 rupees by 10%, which basically gives you 100 rupees. Remember that? Right. Now, this is one particular, method where we have assumed that there is no growth in dividend. But that is a very, very unrealistic assumption. We can make slight modifications to this formula, or rather this whole, whole theory, wherein saying that no, it is very, very improbable that the dividends don't grow at all, because if dividends don't grow at all, then inflation will eat away whatever, dividend comes, and actually the, the stock price, whatever you project, will actually be meaningless. I mean, no company will operate like that. So there will always be some amount of increment in the dividend. And the first method that we use, or rather the first variation or the first change that we bring to this entire dividend concept, is we say that there is a constant growth in dividend. That is, year 1, let's say the dividend is 10 rupees. Year 2, 10 rupees, on 10 rupees, you let's say have 20% increase in the dividend, that it will become 12 rupees. Third year, on 12 rupees, there is a 20% increase in dividend. So the dividend will become 14.4. How did I get 14.4? 12 is the second year dividend. Then the third year dividend is 20% growth of that. What is 20% of 12? Is 2.4. So 12 plus 2.4, that is equal to 14.4. So like that, every year the dividend, let's say, increases by 20%. See, even here you can make a claim, or rather you can come to a conclusion saying, no, boss, how can it be so possible that, or probable that every year constantly the dividend is 20%? No, it is not possible, right? But this forms a foundation, or this rather forms the basis of the Gordon formula. If you remember the Gordon formula, it was D1 by K minus G, or KE minus G. D1 is the numerator, KE minus G was the denominator, where G is the growth rate. G is the growth rate. What growth rate? It is a constant growth rate. So, even for a moment, ignore the fact that it is impossible that the dividends will continuously grow like that at a very, very constant pace. For a moment, ignore that. Even then, the formula gives us a very, very strong theoretical base to build subsequent variations. How is that done? Let us first understand this particular formula, how is it arrived at, and then we'll go into the next one, where we change the dividend growth rate. Initially we have something constant, then it, initially we have a high rate or an exceptional period, and then it changes, or we can have two-stage model. So we can come into multiple such variations. We will see at least a couple of them after this, but for now, first let us understand this particular piece where we have a constant dividend growth. Constant dividend growth. Earlier we saw no dividend growth, now we are seeing constant dividend growth for eternity, forever, right? So let us see that aspect. So friends, if you remember the formula was D1 by K minus G, that is price 0, that is price on today is D1 by K minus G. What is D1? Let us further simplify. D0 into 1 plus G by K minus G. You can call it cost of equity, you can call this KE as R, you can do multiple things, but this is the basic formula, right? I just want to show you how this formula has been derived. Very, very simple. Our present value concept, or present value of future cash flows concept, is the very same thing what we did in the previous case also. Okay, but I'll just take you through the derivation so that you are absolutely clear. There is one specific point I want you guys, all of you, to remember, which you will highlight multiple times. You should never forget this in life. Okay. The thing is, when you are computing price 0, that is, you are there on today. Okay, assume that whatever dividend was declared for last year is already declared, that the money is already been received. The dividend from today onwards till next 1 year, that is, the dividend is receivable for the next year after 1 year. That is the core of the assumption. That is the core of the assumption. That is, future cash flows will start from next year. So this will be D1 will be after 1 year. Then you will have D2, then D3, and so on and so forth till infinity, right? What is D1? Here we are assuming D1 is dividend of previous year, and it is growing at a constant rate of G. It is growing at a constant rate of G. So G is growth rate. D1 is year 1 dividend. Okay. then let me write here only. KE is cost of equity, and what is the pending thing? P0 is price today. So P0 is price today. So you see, today's price is summation of all the future cash flows till infinity, and D1 is equal to D0 into 1 plus the constant growth rate. So D2 is D1 into 1 plus growth rate, which implies D2 is equal to D0 into 1 plus growth rate into 1 plus growth rate, right? Because it is happening 2 times, which is what I told you earlier, 10, 12, 14.4, right? So if you look at this, D2 is equal to D0 into 1 plus G whole square. Okay, this is the first thing that you have to remember. Then, if you plot all these cash flows, right? Here, one specific thing I should highlight. Here, this number is present value. The present value of all these dividends. It is not directly summation of dividends. It is present value of all these dividends. So now, P0 is equal to, let me put same PV and D into 1 plus G, that is first year. D0 is last year's dividend. Next year dividend is D0 into 1 plus G, which is the constant growth rate, plus D0 into 1 plus G whole square. So the second year dividend will be D0 into 1 plus G whole square. Present, so on like this till Dn into 1 plus G whole power n. So far so good, clear? How do you do present value? If the cost of equity is K, what is the present value factor? You divide the year by 1 plus K. So here this will be D0 into 1 plus G divided by 1 plus K. What will it be for year 2? D0 into 1 plus G whole square by 1 plus K whole square. Why whole square? You have to discount the second year's dividend by 2 times. If you have to bring it to present value, you have to discount it by 2 times for the same cost of equity. So like this it will go on till Dn into 1 plus G power n by 1 plus K power n. Okay. Now, if you were to simplify this, what is the sum of an infinite geometry progression? Sum of infinite GP is equal to A by 1 minus R. Now, what is A in our case? This is where you have to pay attention, friends. This is A. We are discounting next year's dividend. Next year's dividend is the starting point of the summation of the cash flow, right? So, next year's dividend is the A. What is R? It is very apparent, no? 1 plus G by 1 plus K is R. 1 plus G by 1 plus K, because that is a constant ratio which is common between term 1 and term 2, term 2 and term 3 and so on and so forth. So, you will write A is equal to D0 into 1 plus G by 1 plus K. R is equal to 1 plus G by 1 plus K. So, sum or PV is equal to A by 1 minus R, that is equal to D0 into 1 plus G by 1 plus K divided by 1 minus 1 plus G divided by 1 plus K. If you were to simplify this further, what will it be? It will be D0 into 1 plus G divided by 1 plus K divided by 1 plus K minus 1 minus G. So, these two will get cancelled, divided by 1 plus K, right. So, you cancel these two, you will get it as D0 into 1 plus G by K minus G. So, you can also write it as price is equal to D1. Why D1? D1 is first year's dividend, that is D0 into 1 plus G. So, D1 by K minus G. You can call it K, KE, whatever you want to call it. This is the formula. This is basically of entire, theory of valuation of any share based on present value, right. This is the underlying formula based on which all the theories have been built, right. You may have, price to earning ratio, you may have other ratio based analysis, all of that. If it is cash flow, If there is a cash flow involved and if there is some earnings involved, in our case it is dividend. So we have taken present value of all dividends at a constant growth rate. So this is the formula. This is the core of everything. If you understood this, you have understood a lot of stuff. Okay. So now first we have understood this part. Now I will take you to one small variation of this. I will take you to one small variation. This is the based on Gordon growth formula. Gordon growth formula. Okay, you have to remember this. On this, I will take you through one small variation which will help you really understand everything together. So let's get into that.